Hey everyone. So let me just start by asking you a question. As you're prepping for your GST paper, where do you think you lose the easiest marks? While the answer might actually surprise you, it's not in the complicated stuff. The easiest, most scoreable marks get lost in those chapters you probably look at and think, that's just theory, and then you just skim right through it. Chapters like accounts and records. And today, we're going to change that. To really understand why this is so critical, let's just play out a quick exam-style scenario. Imagine this. A GST officer walks into your client's office for an audit. What's the very first thing they're going to ask for? It's not your tax calculations, it's not your returns. The first words will be, "Show me your books of accounts." That right there, that is the starting point for all compliance. All right, let's dive into our first section. So, why are records so incredibly important in the world of GST? Well, the answer is all about a major shift in how taxes are actually verified. And this slide really nails the big change. See, under the old tax systems like excise, there were a lot of physical controls. I mean, think of an officer literally standing at a factory gate, checking things. GST just changed all of that. We moved to a system of documentary checks. The department isn't watching your goods move anymore. They're verifying your compliance by going through your paperwork. Your records, they are your proof. And it all comes down to this core principle. GST is based on self-assessment. You calculate your tax liability, you pay it, and you file the return. So, because you're the one assessing yourself, the records you keep are the main evidence the department uses to check if your self-assessment is correct. And here's the crucial point. Your records are your defense. If the department ever disputes your ITC claim and your records are a mess, they could hit you with a penalty equal to the tax amount, plus interest. Good records are your shield. Let's move on to our next section. Now, if records are this important, there's got to be a strong legal basis for them, right? Absolutely. So let's take a look at your legal toolkit for this chapter. These are the provisions you need to have right at your fingertips. The law on accounts and records is mainly in Chapter 8 of the CGST Act, which covers Section 35 and Section 36. And that's supported by Chapter 7 of the CGST rules, specifically Rules 56, 57, and 58. Just memorize these, they are your foundation. And here is a classic exam trap. You have to pay close attention because ICAI loves to twist this. You might get a question about an interstate transaction and start wondering which law applies. Just remember this. Section 20 of the IGST Act is a really powerful provision that basically makes the CGST rules apply to the IGST Act too. So all those rules we just talked about, yep, they apply to IGST transactions as well. Don't fall for it. All right, so we know why we need records and we know which laws apply. So the next logical question for any exam is who's responsible? Who is legally required to maintain these accounts? The law is super clear on this and gives us three distinct categories. First, the most obvious one is every single registered person under GST. Second, every owner or operator of a warehouse or a godown. And third, every transporter. Now, for that first category, the registered person, there's a specific rule about location. The law says you must keep and maintain a true and correct account of all your records at your principal place of business. You know, the one that's mentioned on your registration certificate. Now, this right here is where you can easily lose marks, so please pay close attention. For those other two categories, the warehouse owner and the transporter, there's a critical difference. They are required to maintain records even if they are not registered under GST. I'll say that again, even if they're not registered. This is a huge point. It's a responsibility put on them by the law no matter their registration status. Do not forget this. Okay, finally, before we dive into what records to maintain, we need to be crystal clear on some basic definitions straight from the Act itself. So let's do a quick run through of the key terms. First up, we've got agent, which is defined under Section 2, subsection 5. An agent is just anyone who does business on behalf of someone else. It's a really broad definition, so it includes a factor, a broker, a commission agent, even a deliquidare agent. That's the one who guarantees payment, an auctioneer, pretty much any mercantile agent, whatever they're called. Next, we have the commissioner under Section 2, subsection 24. This refers to the commissioner of central tax, and the definition also includes the principal commissioner. And importantly, it also covers the Commissioner of Integrated Tax, who's appointed under the IGST Act. And finally, the Common Portal, defined in Section 2, subsection 26. You should know the official name for this. It's the Common GST Electronic Portal, mentioned in Section 146 of the Act. But for all of us in the real world, this is the website we all know and use: www.gst.gov.in. Picture this. You walk out of the exam hall feeling pretty good. You remember their retention period was 72 months, you wrote it down, but you still lost marks on that question. Why? This is a classic exam trap, and by the time we're done here, you'll know exactly why it happens and how to make sure it never happens to you. So, to make all these rules practical and easy to remember, let's follow a guy named Mr. Kumar. He's a registered supplier, and frankly, he's a bit confused about all this compliance stuff. His confusion is basically going to be our roadmap to mastering this chapter, one question at a time. This part is a straight up memory test for the exam, so you need to focus here. This is the big list of accounts you have to maintain. You've got to know it by heart. It covers the whole shebang. Everything from production, all your supplies, both coming in and going out, your stock levels, the input tax credit you've availed, and the output tax you've paid. It even covers the special stuff like imports, exports, and reverse charge. Oh, and see that last point? Advances need their own separate account. Don't gloss over that. And the list doesn't stop there. There are a few more details that are super easy to forget, but ICI loves them. It's not just about the transaction amounts. You need the full name and complete address of both your suppliers and your customers. And this one is huge. You also need the address of any place you store goods, even if it's not officially your place of business. Think about goods in a third-party warehouse or even just sitting in a truck in transit. The department wants a complete trail for everything. All right, so those are the general rules that apply to pretty much everyone. But you know how it goes in law. There are always special cases. The GST law has some extra requirements for certain businesses, and trust me, this is prime territory for those case study questions in your exam. First up on our list of special cases, agents. If your business model is acting on behalf of someone else, a principal, then you've got an extra layer of record keeping to worry about. The key thing to remember for agents is that everything has to tie back to the principal. You need to have that authorization letter on file. You need a detailed log of all the goods or services you've handled for each principal separately. You got to keep copies of the account statements you send them, and of course, a clear record of the tax you paid on their behalf. The whole point is to create a perfect, unbroken trail from the transaction right back to the person you're representing. Okay, next up, let's look at two of the biggest players in the economy: manufacturers and service providers. It makes sense that their record-keeping needs would be a little different, because what they do is fundamentally different. The big word to focus on here is quantitative. It's all about the quantities, the numbers. For a manufacturer, you're tracking the physical flow of stuff. They need a monthly production account showing exactly how much raw material went in, what services were used, and how many finished goods came out. And yeah, you even have to track waste and byproducts. For a service provider, it's a similar logic. You need to show the quantitative details of goods and input services you used up in order to provide your final service. Let's try a practical exam-style question. Works contracts are that tricky mix of both goods and services, so you can bet they have their own special rules. So if we have a works contractor named Mr. Harsh Manjula, what specific records does he need to keep? And this is where you really see how detailed the law can get. For every single contract, Mr. Manjula has to maintain a separate set of records. Think of it like a dedicated project file. That file needs the client's details, the supplier's details, a meticulous list of all the materials and services used for that specific contract, and a clear record of payments received. Essentially, each project needs its own self-contained audit trail from start to finish. Let's move on to another key player in the logistics chain. What about people who don't actually own the goods, but they store them or move them? I'm talking about warehouse operators and transporters. Let's use an example. A company called Chill Chain Cold that runs a warehouse. For businesses like these, the name of the game is traceability. They have to keep records of who sent the goods, the consignor, and who's receiving them, the consignee, including their GSTINs. They need to track the entire journey of the goods. For a warehouse, it's even more granular. They need a complete logbook for every single item: when it arrived, where it was stored, when it was dispatched, and how it was ultimately disposed of. They need to be able to point to any box and say exactly whose it is and where it's been. So we've covered the who, what, and where, but what about the how? Do these records have to be in dusty old ledgers, or can you maintain them electronically? This is a point of confusion for a lot of people. Let's tackle this with a quick scenario. We have a Mr. X who is absolutely convinced that all his GST accounts have to be kept in physical, manually written books. Is he right, or is he just creating a ton of extra work for himself?
The answer is a big, resounding no. Mr. X is completely mistaken. The GST Act is actually quite modern here. It specifically states that books of account includes any electronic form of data. So yes, you can absolutely maintain your records digitally on a computer or any other electronic device.
But, and this is a very important but, if you decide to go digital, you have to follow a specific set of rules. And this is a common area where marks are lost. 1. Your electronic records have to be authenticated, usually with a digital signature. 2. You must have a proper backup that you can actually restore. 3. If an officer asks to see the records, you have to be able to produce them, either as a printout or in a readable electronic format. And finally, you have to provide any info needed for access, like file names, passwords, or explanations of any codes you use. Now for a classic ICAI twist. What happens if you make a mistake? How do you correct it? Rule number 1, and this is non-negotiable. You can never erase, efface, or overwrite an entry. The original mistake must stay visible. For manual books, you simply draw a single line through the wrong entry, sign or initial it, and then write the correct entry. For electronic records, your system has to maintain an audit log of every single change, every edit, every deletion. It's all about preserving that audit trail.
And here we are. We've come full circle, right back to the question from the very beginning. How long do you actually have to keep all these records? It seems like a simple number to remember, but the exception is where the trap lies.
72 months. That's 6 years. It's a long time, and it's the number that most students remember and write down.
Now, to be precise, it's 72 months from the due date of furnishing the annual return for that particular year. That little detail is important. But that's not the full story. The real trap, the one that catches people out, happens when there's an ongoing legal case.
And here it is, the answer to our opening question. If a registered person is involved in an appeal, revision, or any kind of investigation, the rules change. They have to keep the records for 1 year after the case is finally disposed of, or for the normal 72-month period, whichever is later. So think about it. If a case drags on for 10 years, you have to keep the records for 11 years. Simply writing 72 months in your exam without explaining this whichever is later clause is exactly why you would lose those marks.
So, what happens if Mr. Kumar just ignores all these rules? What are the penalties for not maintaining proper accounts and records? The consequences are serious, let me tell you. If you fail to account for any goods or services, the proper officer gets to step in and determine the tax payable on them as if you had sold them. They will basically create a fictional supply and demand tax on it. To do this, they'll use the provisions of Section 73 for normal cases, or the much harsher Section 74 for cases involving fraud. In short, if you don't have the records, they get to do the math for you, and you're probably not going to like their answer. So, as we wrap this up, here's the final thought I want to leave you with. It's not enough to just have records. They need to be correct, complete, accessible, and kept for the right period of time. You need to ask yourself, are your records just audit present, or are they truly audit proof? Mastering these details is what separates good compliance from great compliance and makes all the difference in your exams and in practice.